Over the past month, the crypto market has entered a phase that many investors describe as confusing and unstable. Total market capitalization has contracted by nearly 30%, while sentiment indicators have fallen into extreme fear territory. This combination of sharp price declines and heightened uncertainty has created the impression that the market is breaking down. However, the data suggests this is not a classic bubble collapse. What is unfolding looks more like a broad deleveraging process. Trading volumes have increased even as prices have fallen, indicating not only panic selling, but also aggressive repositioning. In derivatives markets, open interest has dropped significantly, and funding rates have turned slightly negative, showing that excessive leverage is being flushed out of the system. At the same time, capital rotation within the market has become more visible. Bitcoin dominance has risen to around 58%, while most altcoins have underperformed. This points to a clear shift toward lower-risk assets, with investors favoring Bitcoin over higher beta tokens. The market is becoming more selective rather than uniformly risk-on. Regulatory developments are another major factor shaping current conditions. In the United States, ongoing debates around transparency legislation, jurisdictional conflicts between the SEC and CFTC, and initiatives such as Project Crypto have increased short-term uncertainty. While these efforts aim to create clearer rules over the long term, the transition phase has left many projects in regulatory limbo, particularly in DeFi and smaller altcoin sectors. Institutional behavior appears contradictory on the surface. Large financial firms continue to build infrastructure, launch products, and signal long-term commitment to digital assets. At the same time, short-term outflows from Bitcoin ETFs show that institutions are actively managing risk rather than blindly accumulating. This disconnect reflects differing time horizons. Institutions tend to think in years, while retail investors often focus on weeks or months. Looking ahead to the next 6 to 12 months, the most likely scenario is not a dramatic collapse, but a prolonged period of consolidation. Market capitalization may continue to fluctuate within the $2 to $3 trillion range, with Bitcoin maintaining relative strength and only select altcoins recovering. A more negative outcome would require intensified regulatory pressure and sustained risk-off conditions, while a more positive scenario would depend on regulatory clarity and renewed institutional inflows. Overall, the current market environment feels chaotic because sharp price declines, regulatory uncertainty, and long-term bullish narratives are happening simultaneously. Yet the underlying data suggests this phase represents a painful reset rather than the end of the crypto market, with the direction of regulation and capital flows likely to determine what comes next.